Good afternoon. Market news now. Asian markets traded higher as Hong Kong and mainland China resumed quarantine-free travel over the weekend, signaling the end of zero-COVID policy, which kept borders effectively closed for nearly 3 years. Hong Kong's Hang Seng Index gaining 1.7% in its final hour of trade on the first day of trade following the reopening. Technology stocks leading gains alongside travel and the consumer names. In other news, oil prices climbing more than 2% as China's move to reopen its borders boosted the demand outlook and overshadowed global recession concerns. Despite today's oil price rebound, there is still concern that the huge flow of Chinese travelers could cause another surge in COVID-19 infections, while broader economic concerns also linger. To talk to us about what we can expect in the coming week and also look back at Friday's jobs report data, we are joined by Gary Boyson, who is a portfolio manager at Rand Swiss. Gary, thank you so much for your time. As I mentioned in my intro, we've got this China reopening story with China reopening its borders. And at the same time, you have the hopes that the US Fed may slow down the pace of interest rates following Friday's jobs data. With all of that in mind, how are you assessing global and local risk sentiment?
Well, certainly, it's a risk on trade once again. So markets up strongly today. You can see the all-share index up almost 2%, driven by the resources, up almost 2.7%. We're also seeing a little bit of a rally in gold. So we're seeing the gold price up at 1878, and that's rallying in Rand terms as well. With the Rand looking a little bit stronger at around 17, you could call it 17 to the dollar flat. I think that's, as you said, with the expectation that interest rates might rise at a slower pace, or the Fed might not be as hawkish as it's been in the past. That's putting a little bit of a shine back onto the yellow metal and certainly helping equity markets, which are rocketing higher. We've had a very, very good 2023 so far.
So on the back of China reopening, what's the main question you're asking yourself as you look at what was happening on the Asian side and your screens right now?
Well, yeah, looking at the China reopening, there's a lot of moving parts here. So on the one hand, you're seeing the Brent crude oil prices rising, and I think that's the expectation that you're going to see the world's number 2 economy opening up and doing a lot more business. At the same time, there's obviously the Russian influence as well. So Russia has come out and said that it's going to potentially curtail supplies. Obviously, the Western allies of Ukraine have put in place that $80 per barrel price cap when buying from Russia, and Russia has responded by now threatening to take between 5 and 7% out of global output. So that equates to about 500,000 to 700,000 barrels per day. So that could explain the lift in oil rather than the Chinese reopening. But I think along with what's happening in China is comments out of the PBOC, so the People's Bank of China, saying that they see an end to the strict crackdown on tech counters, which is absolutely fantastic news if you're an Alibaba shareholder, a Baidu shareholder, and of course, many of the viewers will be Tencent shareholders via the holding in either Naspers or Prosus that sits in most top 40 index products. So most pensions are doing pretty well thanks to that comment from the PBOC. And generally China very, very optimistic at the moment, and it's also helping the likes of Richemont, which is now trading almost back at all-time highs, also a big component in our local index. They obviously very reliant as a luxury goods retailer on Chinese tourism. So many of those Cartier watches and Montblanc pens get bought by Chinese tourists that are traveling, which we're now getting reports are forming queues to renew their passports after being allowed to leave the country for the first time in 3 years.
You touched a little bit on the US jobs report for Friday, but then we also have the US CPI. Does that then determine the size of the hike that we can expect for the February 1st Fed meeting?
Of course, so both the jobs number and the inflation number are key to how we think about where the Fed's path on interest rate hikes is going to go. So as you said, the jobs number was very strong on Friday, so surprisingly strong, and the market liked it. Now, generally, what the market actually wants to see is a weaker US labor market. So it was a little bit surprising that a strong jobs number resulted in higher equity markets and the expectation that interest rates were not going to rise as fast. Now, the reason for that is even while the overall unemployment rate moved from 3.6 to 3.5, when we were expecting it to move to 3.7, the idea that the wage growth wasn't quite as aggressive as expectations, and obviously wage growth feeds into that inflation number. We will get obviously the US CPI numbers out on Thursday. So US consumer price index is currently sitting at 7.1%. The consensus is for that to drop to 6.5%. If you're looking at core CPI, which strips out energy and food, that's expected to drop from around 6% to 5.7%. So we're starting to see the expectation that inflation in the US is going to moderate. If inflation in the US moderates, what happens is the Fed suddenly doesn't need to be as hawkish as it's been in the past, and we might get a little bit of a reprieve from the interest rate hikes that we're seeing. If you look at the Fed funds futures currently, it is pricing in around a 75% chance that we get a 0.25% increase on the 1st of February in that Fed announcement. The balance of the 25% chance saying that we're going to get another 50 basis point increase. But of course, if we get a very good CPI number, as in a very low CPI number out on Thursday, those probabilities will probably shift around and will probably skew it more towards a quarter of a percent increase in February. Maybe even open the door to no increase in February, which would be very interesting for equity markets.
As we wrap up, your 2023 outlook, is the worst behind us, or is it too early to tell?
I suppose it depends on what you mean by the worst. So markets, remember, I think viewers must remember that markets are forward-looking. So is the worst over for markets? It's very difficult to tell. I think we're very constructive on equity markets at the moment. You might get another leg down, but buying almost, last year finished on the US stocks 20% lower in aggregate. So for me, a great time to be buying into the markets. So I think maybe a better year doesn't mean the lows are in, but certainly I think in the next 18 months, you're going to see a nice recovery in stock markets, especially if we do see the Fed starting to even reduce interest rates after 2024. As for the economy, markets predict economies, unfortunately. I think the US is still in for a tough time. I think we are going to see that labor market number tick up. I think there's going to be more unemployment in the US. Right. And of course, South Africa, while our market has been very strong, is still struggling with its own set of challenges, including load shedding.
All right, Gary, on that note, let's leave it there. Thank you so much for your time. That is Gary Boyson, who's a portfolio manager at Rand Swiss. Of course, that all-important US CPI figure coming out on Thursday, and we'll break down what it means for you, of course, the next day, but also looking ahead in terms of what we can expect for the week. That is it from me. We're going to take a quick break. When we come back, we'll have more news for you.